The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
If a trade war tamped down doesn't, save this market, maybe stock buybacks will. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. We'll see if we get more buyback announcements this afternoon.
Yeah.
All right, let's take a look at where things stand for equity markets. The S&P 500 gaining for a third straight day. That is the longest winning streak since April 2nd, Liberation Day. Big tech is leading the way. The Mag 7 up by 2.6%. Alphabet reporting earnings after the bell. We will break it all down for you. You can see also that treasuries are gaining, pushing yields lower across the curve on some dovish talk from Fed officials. However, the dollar not extending the rise that it had been reporting or it had been posting, down for the first time in 3 days, Romaine.
Yeah, a key level on the S&P 500, 5,500. Alphabet doing its best to help get the S&P there. In fact, it's one of the biggest point contributors today ahead of its earnings after the bell, a report that might actually set the tone for a re-embrace of big tech stocks, or maybe the stiff arm. Alphabet would be the largest S&P 500 company to report so far this earnings season, and thus it's going to offer the first consequential look at how mega cap companies are navigating this 1-2 punch of political pressure and recession risk that's bubbled up over the past few months. Of course, when we talk about that recession risk, we should point out that that risk is real risk. Procter & Gamble today cutting its guidance for the year, citing the economic impact of tariffs. PepsiCo no longer expecting earnings to rise at all in 2025, citing tariffs. Finnish telecom company Nokia said it will be hard to meet its guidance, citing tariffs. And Tractor Supply widening its sales forecast range, citing a notable increase in uncertainty because of tariffs.
There needs to be engagement globally, including the U.S., on this situation because, as you can see, investors are not only worried about the economic outlook, but the whole structure of the international system.
And it's not all doom and gloom out there. Resilient earnings reports were to be had from ServiceNow, from Hasbro, and United Rentals, among some others, offering some hope that all this recession talk is actually overblown and that economic conditions can remain stable. If so, then combine that with the continued return of cash to shareholders, whether it's through dividends or buybacks, companies like 3M, AT&T, Citi, maybe even Alphabet tonight. If so, that could provide enough of a floor to kind of keep the stock market stable and, more importantly, help the S&P 500 break through that technical resistance level.
Absolutely. Well said. And of course, the return of cash to shareholders, that strategy does seem to be paying off. So this white line tracks the S&P 500 buyback index, which measures the top 100 stocks with the highest buyback ratio relative to the S&P 500 itself. So when the ratio does go up, as it did here in 2022, that means companies spending on buybacks are outperforming the S&P 500, which is in blue. Now you look at this year. Let's go all the way over here. What you're seeing, of course, is the white line is holding up much better than the blue line. So if Alphabet does announce a bigger buyback program and raises its dividend today, and then you've got cash-rich Amazon, Microsoft, and Apple doing the same, that could stabilize tech shares and therefore the S&P 500 overall. Romaine?
All right, optimism is rising here. Alphabet up for more than 2% for a third straight day as we focus on earnings and, of course, some of the economic signals that might come out of it. Ann Berry joins us right now, the founder and managing partner at Threadneedle Ventures. Great to see you, Ann.
Good to see you.
Earnings so far have not been bad, particularly given some of the expectations coming in. And I know we haven't really gotten to the real meat of it with some of the biggest companies here. But do you think there's any sort of hope we will see more encouraging commentary from executives about weathering whatever sort of trade economic storm we're in the middle of?
Not yet. And I actually think this earnings season's a bit of a throwaway one, if I'm honest, Romaine. You said it's not been so bad, but it's also been looking in the rearview mirror. These are pre-Liberation Day results we're getting. I'm much more focused on the commentary we're getting, and it hasn't been great. And the biggest issue, I think, has been corporates struggling to try and provide guidance. Some people are, Hasbro is one that you mentioned at the top of the show. They were very interesting in saying if tariffs are X in China, then this is why the impact on EBITDA. I think that was one of the better examples of trying to provide concrete guidance. Without it, it's just a big, it's just stasis at the moment, I feel. Yeah.
So then what does that mean, though, for investors? Because I was looking at least based on Bloomberg estimates, kind of expecting stagnant revenue growth for the S&P 500 as a whole. EPS growth is going to be very sort of textured. I mean, you have some sectors that will do well, others that are not going to do well at all. And then kind of in between all that was this idea that the Bloomberg Intelligence analysts were positing of how to preserve margins, cost cutting,
Yes.
Productivity, and whatever other measures they can take.
Yeah. So I think this is exactly the kind of environment. When we've seen it in, I'm not going to say we're in a recession now, but we've seen it in previous recessions and we've seen it in previous periods of high uncertainty. I think two things happen. First of all esoteric bad corporate news gets flushed right now. And we have this dynamic of, we've had this margin pressure. Look over here, there's tariffs. So I think that's going on at the moment. Then they start hunkering down, and I think this is where we see those who can execute cost cut and margin expansion, who has the courage to continue to invest, who has the courage to say we believe our ROI is going to be this. I think we see that in software. So I think we're going to see a delineation now between those teams that can execute and demonstrate execution and those who are stuck with the uncertainty and can't articulate their way out of it.
When you talk about who has the courage to invest, what kind of investments are we talking about here? I mean, are we talking about investing in efficiency and therefore perhaps reducing your headcount, or is it something more deliberate like CapEx?
I think it's both. And so let's talk about efficiency and headcount. When I think back to 2008, when I think back to 2014, there was uncertainty there. We look back at COVID. These were the kinds of times when I think corporations took very hard looks at themselves in the mirror and used this kind of uncertainty, frankly, as air cover to make very difficult personnel decisions. And this is when they start revolving out their talent bases. So that's number one. Two, I think that translates also into making hard decisions around, yes, productivity increases. And when it comes to things like software in the board meetings I'm in, the most difficult conversations we're having right now is around CapEx in hard equipment, right? The easier conversations right now are around investments in cybersecurity and digital transformation. So I actually do think these CapEx decisions...
Are those separate, though?
They should, they shouldn't be, I think, in the longer term.
Yeah.
If you're making upgrades, machinery investments, manufacturing equipment, I'm a long-term believer we're seeing hardware upgrades that are becoming more AI-infused, for example.
Gotcha.
Software, I think, shouldn't be so divorced, but I think in terms of prioritizing it right now, we need cybersecurity improvements no matter what.
Yeah.
If you're worried about stagnating revenue, to your point, Romain, is this net where you now double down on your CRM investments to try and make sure you're optimizing your sales leads?
And I noticed you mentioned the pandemic, and I've read a couple of notes where people are drawing comparisons between the economic damage we're expecting from policy uncertainty this time around with the damage we saw 5 years ago during the pandemic.
Yeah.
You have, just no virus this time. You have the supply chain shock that'll lead to a drop in import volumes, and you also have declining tourism and how that affects certain industries and certain parts of the country. Is this a helpful framework? Is this an appropriate framework?
I was literally just having this conversation in a very light-hearted way, but here is the conclusion I reached. It's almost philosophical. I don't think it's a perfect comparison for the following reason. During COVID, the entire planet was universally united in trying to find a solution, to find a vaccine or to find a cure. Here, we're seeing regions fragmented, we're seeing sidebar deals being struck, we're seeing fundamental discontent and conflict between the two biggest economies in the world. They're not united at all in terms of what outcome they want to get here and how they're going to achieve it. So to me, that's where the analogy breaks down and why this, to me, is more frightening in terms of the long-term damage it could do.
Just playing the contrarian here, though, is the sort of potential economic calamity,
Yeah.
Is it a little more slow moving this time? Because COVID kind of came out of nowhere to a certain extent, relatively speaking. We've kind of seen the contours of this coming. No one knows how it's going to end. And let's face it, a lot of the policies that the White House has proposed are still proposals. They haven't actually been implemented. So does that give, I guess, these companies a little more of a runway to prepare for the worst, unlike, say, COVID, where you woke up in mid-February and realized that, in 6 weeks you're going to have to shut everything down?
Well, let me ask you a question. Would you prefer the V-shape, the sort of dip, and then the quick recovery, which was sort of very, very broadly the COVID, or this longer potential decline, but a much shallower recovery and perhaps not a recovery to where we could have been? And I fear the latter a bit more. And I'll give you some examples as to why.
Sure.
There were certain contours of this I don't think we saw coming in the way that it did. I don't think we expected to see the bond market teeter as dangerously as it did before there was pullback on this tariff policy. I don't think anyone saw 145% tariff levels, which are not sustainable and effective embargoes coming in. And I don't think anyone saw sudden announcements and then having a negotiation period come after it. So I think the way in which this is playing out is forcing people, forcing nations, forcing corporations to consider possibilities that they weren't considering in the depths that they're looking at now.
Yeah, and of course that makes the earnings season even more consequential this time around, not just for the backward look, but more importantly, the forward guidance. And we have to leave it there. Ann Barry, she is the founder and managing partner at Threadneedle Ventures, kicking us off to the close as we do spend a lot of time today talking about the effect of tariffs on corporate bottom lines. We heard from PepsiCo earlier today. And well, they made it clear as to why they missed estimates and why they're going to miss their guidance going forward. Scarlett? Tariffs.
Tariffs. It's a familiar word, and we'll say it over and over again. And of course, we're also going to discuss the state of C-suite sentiment so far this earnings season with the global vice chair of EY-Parthenon.
And of course, we keep our eye on big tech, big results after the bell from Alphabet. Brent Thill, tech sector leader and software internet research analyst over at Jefferies, will be joining us for immediate reaction when those numbers cross the wire. Don't go anywhere. This is The Close on Bloomberg.
Right now in Oklahoma, the Ham Institute for American Energy is hosting its Powering AI Global Leadership Summit. Our Alex Steele is on the ground in Oklahoma City, meeting up with the big names in the energy space, including the U.S. Energy Secretary Chris Wright. Here's what he told Alex about coal, AI, and how tariffs could impact the sector.
Coal has politically fallen out of favor. And again, to me, it's part of too much politics and energy. Coal has been the largest source of global electricity for 100 years. And it will be for decades more. That's just reality. In the United States, coal has been outcompeted by natural gas, and it went from over 50% of electricity. Today, it's in the teens. But that's market forces and competition. Coal is still critical to the American electricity grid. If you shut down all the coal plants today, electricity prices would skyrocket, our grid would destabilize. With modern technology, with scrubbers and pollution control devices, coal is a great source of electricity, and you store it on location. Security and energy requires diversity.
So do you think that coal in the teens right now, that could grow in terms of the energy mix in the U.S., or it's just not going to go away?
It's probably not going to grow market share because the economics aren't there to build new coal plants. But the critical thing is to stop closing our existing coal plants. You said the hyperscalers, they weren't sure they wanted to power their things with coal. Everything they do today is powered by coal.
What about
coal's a sixth of our electricity grid. Every time you turn on your lights, you run your server, they run their businesses. They're powered by coal today.
But the new stuff will come from different things, like maybe nuclear or gas or wind and solar rather than coal.
The demand for the whole grid is, I think that's what the marketplace is telling us today. The fastest growing source of electricity in the United States by far has been natural gas. Natural gas was not a meaningful part of the electricity sector before. It's well over 40% of U.S. electricity today and growing. Natural gas probably hits 50% of U.S. electricity in the next bunch of years. But that's not politics. That's just math. That's just economics.
We're here at the Harold Ham Institute to really get a sense of energy independence plus AI and how the power we have here can really power the evolution of AI. Do tariffs and uncertainty that we see on the macro sense mess that up?
I think what you're seeing, the uncertainty around tariffs, that's a short-term issue. President Trump's got two agendas. One is we've been very welcoming to imports. He wants to get all the other countries to be very welcoming to exports from the United States and imports to their country. So he's pushing to try to get trade more in balance. It had just gotten so far out of balance. And he wants to reindustrialize our country, bring these energy-intensive industries that left the United States and went overseas. He wants to bring those back. And with AI, of course, we don't want to lose it in the first place. We want to keep it here. AI is just like steel or petrochemicals. It's just a very energy-intensive manufacturing industry, and most of that we shipped abroad over the last 25 years. President Trump is keen to bring back those industries. Tariffs will help with that, and fairer trade policies will help with that, and he wants to make sure AI stays here.
So you feel confident when talking to CEOs that they will continue their AI dominant search here versus elsewhere, despite the uncertainty?
The uncertainty is because we're in the middle of a negotiation. The uncertainty isn't going to last forever. That's a few more weeks.
Can I hold you to that, and then we get calm?
I think so. It won't be that long. It won't be that long.
And that was the U.S. Energy Secretary Chris Wright speaking with Alex Steele at the Powering AI Global Leadership Summit, which is hosted by the Ham Institute for American Energy out there in Oklahoma. And, Scarlett, not to step on Chris Wright's toes, but I think a big determinant of what type of energy we use and how much we use in the process probably isn't going to be determined by him. It's going to be determined by a lot of these big companies, particularly the ones that are building out data centers and have a lot of needs for power and, more importantly, sustainable and in some cases renewable power.
Right, and that's why some of those companies have gone out to go buy their own sources of energy. We're talking about Amazon Web Services, Google, Meta, Microsoft. Together, they control almost half of U.S. data center capacity. And most of those data centers are being constructed in specific states. Virginia has the most, Ohio, Oregon. So you're really looking at very localized answers to some of these questions.
And what I love about this, and we should just point out, we're quoting from a great report out by our team over at BNEF. And I mean, it's one of the great things about Bloomberg and really the terminal is just the way they sort of dive into these things with solely an eye on the data and what the data ends up telling you here. Anyway, it's a great report. If you're interested in it and you have a terminal or a subscription to BNEF, definitely check it out here. Meanwhile, we're going to continue to count you down to those closing bells with a push ahead to earnings after the bell, but also a look back to some of the earnings that we got this morning, including Pepsi, one of the biggest decliners right now in the S&P 500 after a less than ideal earnings report, a breakdown of the results, and more importantly, some insights onto where Pepsi goes next with Nik Modi, Managing Director over at RBC Capital Markets. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off today in the banking sector. M&T, Deutsche Bank upgrading the bank to buy, though it does trim the price target to 210 from 225. Now, following earnings, the analyst is now betting that bank stocks have bottomed after hitting bear market territory. The analyst adding that he sees more upside within the large regionals, like an M&T versus the mega cap banks. Those shares up 2.5%, up for a third straight day. Next up, Cadence Design Systems. JP Morgan raising its recommendation on the chip design software company. They're overweight and nudging the price target up to 325. The analyst says the stock's recent underperformance creates an attractive entry point for a stock that they view as having limited impact from trade and tariffs. A third day of gains for that stock. And we should point out it's now up about 20% from a year-to-date low set just at the start of this month. All right, let's take a look at Mondelez, a totally different story here. The maker of Oreo, Ritz, Cadbury, Toblerone, all your favorites. D.A. Davidson downgrading to neutral because of soft snacking in the U.S., not to mention an uncertain outlook for emerging markets amid global trade, inflationary, and political risk. The analyst says the recent rally in the shares leaves the stock near fair value heading into its earnings report next week. Those shares on a two-day slide, 2.6% here on the day, and those are some of our top calls. Let's stay in the food and beverage space, snacking, if you will, and maybe what ails Pepsi could ail Mondelez as well. PepsiCo fizzling after the food and beverage company missed core EPS estimates in the first quarter and lowered its profit outlook for the year due to tariff headwinds. The shares having their worst day since at least 2022. Nik Modi joins us right now, Global Co-Head of Consumer Research at RBC Capital Markets. And Nik, I was just taking a look through just kind of your general coverage of the stock. You've kind of been neutral on this stock for at least the last 4 years or so. And I see you've ratcheted down your price target little by little over the last couple of years here. What did you learn out of the report today that would make sort of any meaningful change in your view of this company?
Yeah, I mean, look, nothing I heard today really changes much, right? We were anticipating a lot of weakness coming out of their snack business, which effectively is their largest business. And certainly then some of the macro uncertainty in many parts of the world and also the tariff risk was also had to be contemplated for, right? So I think this is kind of the theme of this earnings season for many of the consumer products companies, right? And we've seen Procter lower numbers. We've seen Kimberly-Clark lower numbers. I mean, it's happening across the board. The only anomaly has been Keurig Dr. Pepper so far, and the stock is obviously has done well as a result. So at the end of the day, I think there are a few things that are plaguing Pepsi that they need to really work through. And I think the biggest one is that they took a lot of pricing on snacking. Lower-income consumers, middle-income consumers are under a lot of pressure. That's really hurting them, and they're losing market share as a result as consumers trade down and move to other brands.
So what do you see, at least in the short term, Nik, as any optionality they have to sort of protect the bottom line, to protect margins if some of the more dire scenarios that they laid out when it comes to tariffs and economic weakness does play out?
Yeah, I mean, they're in the middle of a big restructuring where they're combining certain divisions and they reorganize their whole P&L. So we're going to have to rebuild our model as a result. But that's going to create a lot of productivity, right? So effectively what they've done is they've combined their North American beverage business and their North American snack business together. And so that's going to allow them to kind of streamline, take out costs. But these things take time, right? And so you don't just announce restructuring, then all of a sudden start accruing the benefits. That will probably start happening in the second half of the year. And so, there's going to be a gap, and that's probably why they had to bring their numbers down.
I want to talk a little bit about Pepsi relative to Coca-Cola, because there have been some talk about boycotts by a certain segment of the population. And I'm wondering, to what extent is that benefiting Pepsi, or is that something that we could look to see as a benefit in the coming months?
Yeah, I mean, you can see it in some of the data for sure, right? So Pepsi, trademark Pepsi, has been under a lot of market share pressure. Coke has been a beneficiary there, and you've seen that reverse in the last few months. There's a lot of things going on there. Pepsi is obviously benefiting to some degree of some of the backlash that Coke has been experiencing, but also Pepsi's been also much more aggressive on promotions, right? So, you have to think about all those things together. At the end of the day, we think that this is more of a dislocation air pocket for Coke. We think long term, we still think Coke has the better brands and has the better business model.
You mentioned Keurig Dr. Pepper as well, and of course that company did report first quarter net sales beating analyst estimates. The stock is lower today, about 2%. But what is it that Keurig Dr. Pepper did do well and could execute on, and how much of that is replicable at a PepsiCo or Coca-Cola?
Well, the first thing they did is, going back to last quarter, they actually provided pretty realistic expectations, particularly in their coffee business, which they were quite negative on 3 months ago, right? And that has manifested. It was actually slightly worse than they thought, but I would say investor expectations were set at a good level. That's number one. Number two is that they're getting a lot of momentum in their beverage business. I mean, their carbonated soft drink business, driven by Dr. Pepper, driven by 7-Up, have really, really done well. They've been taking share. So that's been driving. And then they have a lot of productivity, and they have some partner alliances with some brands that they've are either distributing or have acquired that are also providing some incremental growth. So, they're, I would argue, probably the most defensive of the carbonated soft drink or the non-alc beverage companies, because they have very limited risk from tariffs relative to the other players.
All right, good stuff. Nik, thank you so much for joining us. Nik Modi over at RBC Capital Markets on PepsiCo and its results today. Coming up, we're going to speak with...
Are you a Coke or Pepsi person?
Neither. I don't drink either. What about you?
Neither.
Okay, from a couple of water drinkers.
Two experts here.
Exactly. We're going to speak with Andrea Guerzoni, the Global Vice Chair of EY-Parthenon, about how the global trade war is influencing C-suite sentiment, not just here, but abroad as well. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. We had gains in the stock market today, but I can't say that the mood is necessarily positive either.
Yeah,
There's still a lot of lingering concerns.
A lot of lingering concerns, and I agree. I mean, it's 3 days of gain, so we can't poo-poo that, and which is something that, given the sell-off, is certainly
welcome news.
Needed.
Yeah.
But of course, you look at the levels where the market is relative to where they were just a few months ago, in fact, just a month ago, and you get a real sense here that investors still are on the sidelines.
Absolutely. And a lot of it hinges on what corporate executives say on earnings calls.
Yeah.
And the ratio of positive to negative comments on macro conditions this earnings season is on track for the worst proportion since 2009. And I guess it makes sense. I mean, it feeds on itself. Who's going to stick their neck out to say that things are really great? It's much better to under-promise and over-deliver.
Yeah, and I think most companies have done that, though there were a couple outliers earlier this week where you're kind of like, okay, don't set yourself up for a fall. But it gets to this idea that CEOs and CFOs, for that matter, now are in a weird bind because they have to communicate something to the market without necessarily panicking them, but at the same time, keeping expectations realistic for a world that is almost right now difficult to provide any real expectation.
Impossible to predict, right? I mean, they kind of have to prepare for all eventualities, and that's difficult to communicate in an earnings call. So let's bring in Andrea Guerzoni. He is Global Vice Chair of EY-Parthenon to get a sense of how CEOs are managing through this. And Andrea, I'm wondering how CEOs can offer a nuanced and yet realistic assessment of the geopolitical risks out there when they themselves have no clue about how to proceed. I mean, you can't be completely honest and say, who knows? You have to give some kind of guidance, but the guidance you're offering is so imprecise.
Yeah, no, thank you for having me, and hello, everyone. It's a very good question, and there's no doubt that communications in this environment are very complex. But there's to say that the mood has changed significantly over the last couple of weeks. But the long-term strategies may not be affected that much. I mean, I think it's still too early to judge whether this turmoil, this situation that is being created by tariffs and trade that obviously are taking the center scene in this moment in everybody's agenda, are here to stay, and to which extent these are going to impact the long-term strategies. So I think there's a lot of wait and see from my perspective, and CEOs are looking at this in a very tactical manner at this moment. And I think there's a good reason for not panicking and not communicating dramatic shifts until the dust settles.
Right, and that could be a while from now. So there's the communication part of it, then there's a strategy and execution part of it as well. What's the skill set needed to guide a multinational company in this kind of environment compared to during the height of American exceptionalism when the world was a lot more clear?
Yeah, I think that the world hasn't been particularly clear over the last decades at least, and has become more and more uncertain with incredible forces, disruptive forces from the geopolitical situation that we've been experiencing over the last years, the disruption coming from new technology, AI in particular. I mean, has never been an easy environment. This has just exacerbated a situation that was already very uncertain. So you can see, and this is obviously coming also from clear from our surveys, our interaction with CEOs, that they have become much more acquainted with this kind of uncertainty, and more and more they are injecting resilience into their business plans. They're trying really to project a future that may have different scenarios. Scenario planning is becoming a fundamental tool to ensure that as the situation unfolds and develops, we can recalculate and actually set a new course for the business, adjusting for this sort of situation.
I am curious, though. What are you hearing, Andrea, about sort of where they're going to actually put capital? Because we came into this year, at least with some of the big publicly traded companies, a lot of them are sitting on a lot of cash. They had plans to invest in CapEx that was, in theory, designed to further their businesses for whatever new future we were going into. You had Wall Street sitting on a lot of flush cash, looking to do deals, whether M&A, IPOs, whatever. That all seems to be in stasis right now. Has there been any discussions, anything you've heard that we could see a pickup in that, or are CEOs just going to sit and wait until they get clarity on trade and the economy?
Oh, Romain, there's no sitting and wait for a CEO. I mean, you need to take actions and you need to do it with a clear view to improving your business and ensuring resilience. So first of all, I think just to get the facts right, I mean, the first quarter of this financial year actually was a quite exceptional quarter in terms of M&A activity. They announced M&A transactions amounted to almost $1 trillion, 25% up compared to last year. And March itself was a very good month. Actually, almost half of that amount was recorded in March. Right. So obviously April, if you look at April, the numbers are quite different, and there's a clear slowdown. I think to date, we are about $200 billion transacted in terms of announced deal. So it's not zero. It's not really completely stopped.
Right.
Where they put capital? They put capital where, in this situation, it's obvious that would come to fruition. I mean, the supply chain aspects of the business is going to be of fundamental importance. Building multiple choices, having resilience in the supply chain, updating their products, trying to find ways through innovation to dodge actually the impact of tariffs. And again, trying to reduce through investments operating costs. These are some of the investment that we see our clients are making.
Well, I am curious. So on the deal front, Andrea, I mean, we did see, I think if at least on a year-to-date basis now, we're already like somewhere in the $1.3 to $1.4 trillion range in terms of announced deals. But of course, some of those are really big deals that have skewed it a little bit. But I'm curious about the types of deals. I mean, we were speaking with the CEO of FIS and Global Payments last week about a deal that was clearly very, very pinpointed, strategic. And a lot of the other deals we've seen are similar in nature. We're not seeing a lot of financial transactions. We're really seeing almost vertical integration. Is that a mischaracterization?
No, I think it's fair. I think you can really see that this activity is skewed towards certain sectors, and it's skewed towards certain dynamics. Tech is a fundamental driver there. Really the ability to exit certain countries, obviously realizing the difficulty of trading and managing businesses in certain geographies and moving really the core of the business or certain operations in other geographies is another element. You can clearly see that there is an element of divestment triggered by the geopolitical situation, regulatory situation, and tech. So not all the sectors are so active. If you look at the last couple of months, I think there's been quite a significant activity in consumer product, aerospace, defense, industrial products, but for different reasons.
All right, Andrea, well said here, and it's always great to get different perspectives as you really understand just how complex the current environment is. Andrea Guerzoni, he is the EY-Parthenon Global Vice Chair. All right, we continue to count you down to the close with a look at the broader markets and a look on some of the individual movers. Second best gainer in the S&P today is a toy company, Hasbro. Rising on the back of a better than expected earnings report, we take a closer look in our stock of the hour up next on Bloomberg. All right, shares of Hasbro having their best day in years, up about 15% after the toy maker reported better than expected EPS, better than expected revenue, and said, that forecast we gave you before? We're standing by it. The company said its gaming unit is doing well, and as far as the impact of tariffs, the CEO says Hasbro is well positioned to weather the current trade uncertainty. Lindsay Dutch covers this company for us over at Bloomberg Intelligence. A fun company, Monopoly, Dungeons and Dragons, Peppa Pig, I'm told, Lindsay. I would think any company that sold toys to children would be able to navigate any environment. Is this what we saw today?
Yeah, so we definitely saw better than expected results. First quarter is always seasonally weak when we think about toys, but as you mentioned earlier, Magic the Gathering had a very strong quarter. It was expected to have a strong quarter, but it came in even higher than we were expecting. Their outlook for toys for the year was pretty conservative going in, and that first quarter was good enough that they were able to keep it flat with those first quarter results.
So, I'm sorry, go ahead.
Oh, no. I wanted to piggyback off of that because digital gaming is kind of where the growth is at for this company. Was that planned or was that already in, something that was already in progress and it just so happened to coincide with this tariff trade war?
Yeah, so Hasbro has been looking to grow its digital gaming business and become more known for digital gaming over sort of the standard toys and games. However, consumer products does still remain dominant. If you look at the year, consumer products has the strongest fourth quarter seasonally, and it's still sort of expected to be well over 50% of total revenue. But early in the year, Wizards dominates. And it did come in slightly better than expected on that first quarter. It's looking strong heading into second second quarter. So there's continued strength there.
I am curious. I know the digital side maybe acts as a buffer, but can you expand a little bit on what you thought of their comments about having a relatively minimal impact from tariffs? I know they talked a lot about how a lot of things that they sell in certain markets are manufactured in those markets, but on an aggregate basis, at least based on the data on the terminal, something like 80% of their supplier base is outside the U.S.
Right. So Hasbro gets about 50% of their toys and games revenue from products made in China. That actually is higher than their peer Mattel, which is closer to 40%. But because they have that digital gaming segment, as a whole coming off the company, the exposure is a little bit down. They're accelerating plans to move out of China, looking to get to 40% of the toys and games a little bit faster than they originally anticipated. But when you compare them also to the industry as a whole, toys as a broad industry, the industry is 80% coming out of China. So on a relative basis, Hasbro is in a position of strength in terms of being at about 50% now, trying to move that lower and having the offset on the digital side.
All right, Lindsay, thank you so much. Lindsay Dutch of Bloomberg Intelligence, who covers Hasbro. And I would think that in terms of pricing power, Romain, when it comes to digital games, you probably have a little bit more pricing power than you do with physical toys.
I would think so, because you're kind of dealing with two customers. You have kids who, of course, parents are usually going to give in to their kids' demands. And then for the adults who are playing, Magic the Gathering and stuff, that tends to be a pretty rabid fan base.
And it's subscription only, too. So this gets billed to you every month before you realize it.
Yeah, and when the apocalypse comes, where do you want to be? Out there fighting the zombies, or in your closet playing Dungeons and Dragons with your
There you go, the question of the hour. All right, coming up, we're taking you to the closing bell with Sinead Colton Grant, CIO at BNY Wealth Management. This is The Close on Bloomberg.
Here, we're seeing regions fragmented, we're seeing sidebar deals being struck, we're seeing fundamental discontent. This, to me, is more frightening in terms of the long-term damage it could do.
And Barry, kicking us off to the close 50 minutes ago for over at Threadneedle Ventures. And Scarlett, we're looking at a market that's put together a 3-day rally. And despite Ann Barry's basically making it clear there's still a lot of fear out there, we are at session highs here for a third.
Yeah, and we're actually at the highest level since April 2nd, Liberation Day. So we've made up a lot of lost ground. And according to Goldman Sachs, if you look at systematic funds, the selling pressure has really eased. We are in oversold territory, and sustained rallies, if you can call what we have right now a sustained rally, will likely extend demand. So, momentum is building on itself. You look at the Philadelphia Semiconductor Index, up 5.5% right now, with all 30 members gaining at least 2%.
Yeah, and we should point out all 7 of the Mag 7 are in the green here on the day. And that's important, too, because we get one of the biggest Mag 7s reporting. Alphabet, at least, is going to be the biggest company so far to report earnings. And I think there are a lot of people not so much concerned about Alphabet's earnings specifically, but whether we can get a broader read, at least when it comes to the tech space, the ad space, obviously AI spending, CapEx, a lot of things baked into that report.
Well, they did reiterate that they're going to spend about $75 billion for this year on CapEx fairly recently. So people are expecting them to hold to that. But, the gains that they see in cloud computing will be really interesting. Also, what kind of advertising hit they take from Chinese e-commerce companies.
That stock rallying into the close, up about 2.5%. Of course, we also get Intel, Weyerhaeuser, Skechers, as well as Boston Beer. Sinead Colton Grant joins us right now. She's the Chief Investment Officer over at BNY Wealth, helping us count you down to the closing bells. And Sinead, I kind of want to start off on where Ann Barry left off. She talked a lot about still a lot of fear, a lot of concern in this market amongst investors, and for that matter, amongst corporations as well. Are you hearing a level of fear or a level of panic amongst your clients right now?
Certainly not panic. But there is uncertainty. It's a very fluid situation. The last 3 days have been great, but it's also because we've been hearing more constructive tone from the administration, right? There's potentially a deal almost done with Korea. Everyone wants to see what that looks like, because that's potentially the shape that every other economy will follow. But we still don't know, right? And the thing that we really don't know about is the consumer and how the softer sentiment feeds into the harder data, because that's our real concern. The longer that this uncertainty extends, the more likely it is that consumers pull back. And we know it's been the top 10% of consumers that have really been buoying the economy. That can slow growth significantly.
But that's a concern now, too. I mean, we've gotten some earnings reports from kind of more consumer staple-y companies that have showed a pullback in consumer spending. But we also got some earnings reports out of the European luxury brands. Kering, Gucci reported today a huge drop in revenue. And I am curious as to whether we are starting to see cracks among those that have the means to spend but just aren't spending.
Well, think about where that top 10% of consumers has their wealth, right? A lot of them are invested in the market. So you've already seen, a 20% drop from the high. That's going to curtail spending across the board.
Yeah, it's definitely going to make you think twice about spending. And we've seen this decision paralysis. You mentioned that there may not be panic among your clients, but there's a decision paralysis in C-suites. Is there a decision paralysis among investors about how to position, or are they just going to just sit there and stand with what they have until there's clarity?
The most important thing that we talk to our clients about is that you need to think about a 12 to 18 month time horizon when it comes to the market. And so what do you expect for growth? What do you expect for earnings? And remember that the markets bottom well ahead of earnings. And so that brings a lot of opportunity with it. But you mentioned also about businesses making decisions. That's one of the areas that we're watching really, really closely, because in this kind of uncertain environment, very hard to make investment decisions. And that's investment decisions across the board, not just a new plant, but it's also about hiring. It's also about firing. And so the potential read-through to the labor market is significant.
Absolutely. In terms of spending on technology, we mentioned how Alphabet's going to be reporting after the close. We'll be monitoring that carefully, certainly on CapEx, but also on efficiencies, because that's the one area where I think companies feel they have some control over and they can really, tweak things and make a difference.
We're also going to be looking at AI spending, because you want to focus on how that's going to generate efficiencies, but also what are the other areas of tech spending that are being pulled back from as a result. And that's typically what we've seen, right? It's not necessarily an expanded allocation overall, but it's a rejiggering of that allocation towards AI. And then this is what we've said is always going to be the show me year, right? Not just the show me year for the tech companies, where you've seen a lot of enthusiasm last year about the potential benefits of AI, but this is the year where you need to really see it move through into a lot of other sectors, right? What are the tangible benefits that you can see from deploying AI?
There are a lot of sort of broad structural themes that are probably still intact, like AI, no matter what's going on with trade and everything else. But we are seeing a rotation to a certain extent geographically. And I don't know what the data shows in terms of the severity of that, but anecdotally, we've talked a lot here about the outperformance that we've seen in public European markets relative to U.S. markets, and even in the private space, even in corporate bonds as well. And I am curious as to whether you see any value in reallocating outside the U.S. to some of those areas.
Well, let's take a step back and remember what really would have triggered a lot of that rebalancing. It's, you look at how far down a lot of European markets were last year. Naturally, you rebalance out of the US, which did better, you buy European markets. Undoubtedly, there are opportunities there. We think it's really important that you're active, because you want to focus in on individual names that are poised to do well, because let's not forget that economic growth in most European economies generally hovers around the 1%, possibly the 2% level when the years are really, really good. So we are not underweight, but we're waiting for, you know what we're really waiting for?
No.
It's the implementation of the infrastructure report that Draghi released about, the end of last year, right?
Yeah.
The fundamental changes that are needed to unleash growth in Europe. You start seeing that in conjunction with defense spending. That's a catalyst.
Well, that would be a huge catalyst. And in fact, I mean, it's funny you bring up the defense spending, that's sort of been one of the unintended consequences of all this, that they finally kind of broke free of those budget constraints. But I agree with you on that Draghi thing. If they do release that and they follow through on it. That could be big. Sinead Colton Grant, always great insights, Chief Investment Officer at BNY Wealth, with just about 3 minutes until those closing bells. Scarlett, the S&P and the NASDAQ now at session highs.
At session highs, and of course, we're awaiting Alphabet's results, what they say about CapEx, specifically on AI, specifically on other efficiencies, and also what they say about all the regulation issues that are hanging over them.
Are you not interested in Skechers? I know you're a big shoe person.
Yeah,
they
Skechers
report
not my
earnings
thing.
too. Okay.
Are they the ones with the wheels, or that's another company?
Those are Heelys, aren't they? I don't know.
Yes,
those.
That was a big 90s thing.
Did you have
No,
those?
no.
Okay.
I just
You would
watched
have been an adult by then. All right, full coverage of all those earnings, full coverage of all of today's market action. It starts right now with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu, taking you through the closing bells with a global simulcast that starts right now. Carol Massar and Tim Stanovic join us from the radio booth. Alex Seal on assignment in Oklahoma City. Welcome to our audiences across all of our platforms, including our partnership with YouTube. Carol Massar,
yes.
Stocks up for a third straight day. Stocks at session highs. Why are you so pessimistic?
I'm not pessimistic. I constantly ask what fundamentally has changed, because I know we're watching everything out of Washington, but I mean, you still have a lot of CEOs coming in on earnings saying uncertainty. So I don't know. It's an interesting move. 3 days higher on the S&P.
I was surprised to find that we are only 10.7% off of all-time highs on the S&P 500. Remember, it was just a couple of weeks ago that we hit that bear market. We didn't intraday. We didn't close there. But now we're down barely 11%.
Yeah, but that's where numbers really, really mask a lot of the bigger issues. Is it doesn't feel anywhere close to our being near record highs, right? There have been a couple of people we've talked to, and I don't know if you guys have heard similar, that are comparing the economic damage we're experiencing right now to what we saw during the pandemic, just that there's no virus this time. And I find that an interesting comparison, or at least an interesting frame of reference.
Yeah, absolutely.
Yeah.
But this gets to this idea, though, and I just kind of want to refocus on earnings for a second, because we're now going to get the real mega caps coming into play with Alphabet tonight, and then next week we get Microsoft, Meta, and a few others. And it gets to this idea as to how are they weathering the storm so far, and what are they expecting to do over the next couple of quarters?
Yeah, the one thing I want to mention in terms of the S&P 500, Eric Weiner of our Bloomberg News team said up 6% in the past 3 days, best 3-day stretch since 2020, if you back out that big rally after Liberation Day and all that mess.
Well, the S&P closing out the day higher by about 2%, and that is certainly impressive to be sure. A key technical level to keep an eye on is that 5,500 level. We closed right below it, 5,484 and change. The NASDAQ composite higher by about 460 points, or 2.7%. The Dow Jones Industrial Average adding about 1.2%, and the Russell 2000, a really decent day here, up 38 points, or 2%.
All right, and the S&P 500, no surprise, pretty broad-based here. You have about 405 names to the upside, Scarlett, 97 to the downside.
All right, a very broad advance, too. We're looking at tech, communication services, and consumer discretionary, leading the gains. The weak link here is consumer staples. It has been the best performer since April 2nd, in that it's little change, with at least 1% declines for all the other sectors.
Yeah, and it's kind of fascinating to see some of these earnings that are coming out in the companies, like Alphabet. It's up about 2.5% in today's session. Alphabet's up more than 4% ahead of earnings. So interesting to see the enthusiasm by investors kind of ahead of some actual
What did you
numbers.
say about Alphabet up 14% in the last 3 days?
S&P up 6%. Oh, no, Intel
Alphabet.
up 14%.
Oh, it was Intel. Thank you.
All right, guys, Intel earnings are crossing the wire right now. Let's get right to it. The company in the most recent quarter saying that adjusted EPS did come in at about 13 cents a share. I'm not quite sure if that's a beat or a miss. We'll have to come back to that in a second. On the revenue side, the company did beat there, $12.67 billion. The street was looking for $12.3 billion. The guidance for the second quarter, the current quarter, here's your revenue range, $11.2 to $12.4 billion, so a wide range. But the top end of that range is below the average of street estimates. The street looking for $12.9 billion. So on the top end of that range, that would be a miss. The company also saying that for the second quarter, it expects no EPS on an adjusted basis, basically a flat line. The street was looking for profitability of about 7.2 cents here. There's a lot to go through this release, but we should point out that the new CEO has only been on the job for a few weeks, and we get into that situation as to whether or not this becomes a sort of one of those kitchen sink things as he tries to map out a plan for the future. Intel share is moving lower right now, down by a 2%. And I'm looking looking right now, and I see Alphabet crossing the wire.
Yeah, let's go to that right now. Alphabet's first quarter EPS beating analyst estimates, $2.81. That is 80 cents higher than what analysts had anticipated if we're comparing like with like. Revenue, $90.23 billion, better than the expected 89.1. When you back out the traffic acquisition costs that they pay to partner websites and partner companies, $76.5 billion. Analysts were looking for $75.4 billion. Google Cloud revenue. This is the big one because it's, of course, a driver here for revenue overall. $12.25 billion, $12.26 billion. Analysts were looking for $12.32 billion. So that is a miss on the Google Cloud revenue. In addition, Alphabet announcing a 5% increase in its dividend. And Alphabet as a big tech company having a dividend is already kind of mind-blowing. But the fact that it's increasing its dividend, that just shows you how the state of the world has changed a lot. The stock right now moving higher in after hours trade by about 5.5%.
Of course, AI being called out by Sundar Pichai, the CEO of Alphabet, calling out Gemini 2.5, specifically calling it the most intelligent AI model, our most intelligent AI model, breakthroughs in performance and an extraordinary foundation for future innovation. Search saw continued strong growth, boosted by the engagement we're seeing with features like AI overviews, which now is 1.5 billion users per month. Driven by YouTube and Google One, they surpassed 270 million paid subscriptions. Cloud grew rapidly with significant demand for our solutions. So perhaps not a pullback in build as some were concerned about?
I don't know. Let's talk about that and just continue to watch because you got Alphabet up about almost 6% here. Just real quickly, I want to mention T-Mobile also out with their results. The company raising its 2025 financial guidance. Also, a red sticky from us here at Bloomberg. T-Mobile postpaid phone net adds, 495,000. That's a miss in terms of what the street was expecting. Street was looking for a higher number at 506,557. In terms of the outlook, fiscal year core adjusted EBITDA of $33.2 billion to $33.7. That compares with the street estimate of $33.47 billion. Again, T-Mobile remained just down just a hair in the aftermarket.
Yeah, kind of interesting to see those results out of T-Mobile, specifically on the back of a pretty solid beat that we had out of AT&T a few hours ago. I do want to go back to Alphabet, of course, the biggest company in the S&P 500 to report earnings so far. They really did come across much higher than expectations, more so on the guidance, less so in the current quarter. And I just want to break down specific things. When we talk about the ad revenue of this business, which is still, to a certain extent, the big driver here, you're still talking about near double-digit percentage growth. I think it was 8.5% to be specific. And then, of course, on that services revenue side, you're at growth of about 9.8%. So for a company of this size to be posting up those types of numbers is pretty good. YouTube up about 10% as well. One thing, though, that an analyst talked to me about this morning that he said that we should really pay attention to is the company's Waymo and the sort of rollout of the autonomous driving and how that could actually be a net benefit to the bottom line relatively soon, in his words, at least. So it'll be interesting to see if that comes up on the conference call.
That would still be in the other bets category.
Yes.
Right?
They don't break it out, so we don't know.
Other bets operating loss was $1.23 billion. That was up 20% year over year. The estimated loss was $1.12 billion. Still relatively small when we're talking about Alphabet, but I think that's an area where a lot of people are optimistic. But make no mistake, this is a company that makes its money still on search and advertising.
Let me just jump in really quickly because we also have Skechers, the shoe company, reporting results. First quarter adjusted EPS, $1.17, beating the consensus estimate by 1 penny. Net sales, $2.41 billion, coming in lighter than had been anticipated. Full bottom line EPS, when you include a gap, it's $1.34. That is higher than anticipated.
Yeah, I want to go back to Google as we continue to see this up in the aftermarket. I mean, we talked, the company also saying first quarter Google Cloud revenue, $12.26 billion versus an estimate of $12.32 billion. What our Mandeep Singh said is that it is all about search. That is still the business, and that's what you want to see in terms of strength.
But I just want to go back. I mean, you guys kept interrupting me. I was supposed to rebut Tim. By the way, Tim, that fly is still in the men's dressing room. If you can deal with that, by the way. It's driving me. There's a gigantic fly in the men's dressing room.
All right, do you have something to say?
I do, actually. So we talk about the valuation. So I just want to get to this point on Waymo, though, because this was Brian Nowak over at Morgan Stanley who was talking about this, and he did publish a note, so this is public. He talked about this idea of how the Waymo unit as a standalone could be valued at something like, $45 billion minimum, and that's based on the last funding round. So in his idea. It would be a lot more than that. But compare that to what we learned out of the trial, where they're saying that the Chrome standalone browser would be valued at $50 billion. So at least if you believe what Brian Nowak has to say, you're talking about a Waymo unit that is still relatively nascent, that in theory, at least on paper, is just as valuable as the Chrome unit.
You know, I just have to say something else. We mentioned the 5% increase in dividend. It's now 21 cents a share. Also, an additional buyback program authorization of $70 billion. Maybe that's why the stock is moving higher. I know that we reported this beat on revenue and everything, but at the end of the day, investors are looking for stocks that can deliver, that can return cash to shareholders, and this is exactly what Alphabet is doing. If nothing else, it's got a ton of cash sitting there, and it can use it in this way.
Can Romaine and I talk more about Waymo? Because
how about the fly in the dressing room?
Now,
Romaine, have you been in a Waymo?
I have not, because I'm chicken.
It's incredible. So, yeah. I've done it twice in San Francisco. Look, they're growing, they're expanding, they're in other parts of the country. I think one concern people have is they don't know how much these Waymo vehicles actually cost to build. The Jaguars, the technology is, we think, really expensive. Max Chafkin has talked to us a lot about that, about we don't know what the numbers are there and if they're adding up to something that is, look, obviously other bets lost money, but if it is something that can be scaled at a relatively, we're talking margins for a tech company, right? This is really expensive hardware. This is not like the Chrome browser.
That's why it's going to be stuck in other bets for a long time.
Yeah, it really has.
All I'm going to say is, as you said, Romaine, this is one of the largest market cap companies out there. When we talk about the Magnificent Seven, like this is one of the companies, if it was disappointing, this would be a bit of a bummer, right, in this market environment. For it to come out with these numbers, for it to do the buyback and all these, to feel like it can do these things, it's pretty impressive.
And we've been here before, right? I mean, we've been here where a lot of investors have sort of discounted, if you will, some of these mega cap companies, saying that, they've kind of gone too far, too fast. And usually we get a course correction. Course correction back to the upside, where these companies let it be known that they could pretty much just throw off cash pretty much as they please, at least when it comes to Alphabet, to maybe to a certain extent Microsoft, and maybe to a smaller extent Apple.
But their numbers weren't bad.
No, they weren't. And I really think that the way Sundar Pichai puts it in the commentary that he gives really showcases how the focus has moved away from AI towards the fundamental strength of its core businesses, whether it's search, whether it's YouTube, whether it's the cloud business. AI gets a mention, but beyond that, it's really about, hey, we're executing on all fronts.
All right, stocks up about 5% here in the aftermarket. So investors, at least so far, liking what they got from the company. And just a quick check on Intel as we go out here, guys. We're seeing that stock also moving around in the aftermarket. It is down almost 6%. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Scarlett and Romaine continuing out there on television, and Tim and I are going to continue right here on Bloomberg Business Week Daily. We'll see you again.
The fly, Tim. Get it.
I'll get it. Don't worry. I got you.
You got to get the last word, don't you? All right, we'll see you tomorrow, guys. I know.
You couldn't resist.
And we continue our coverage here on Bloomberg Television. A trifecta of gains for the broader U.S. markets, and S&P up 2% on the day. In fact, all of the major indices pretty much up 2% on the day. The NASDAQ adding about 3%, and the Russell 2000 up about 2% here as well. On an individual basis, you saw a lot of individual stocks get bids. We are waiting to hear what the sort of outcome of an executive order signing out of the White House could mean. We saw a lot of metal stocks rallying on speculation as to what that executive order could be. We'll sort of keep an eye on that and see if there's anything to break on that. But of course, we have to turn back to the top story of the day here. And that, of course, that includes everything that's been going on in the tech space when it comes to the state of big takes. Alphabet moments ago became the largest company in the S&P 500 to report results. 4 of its Mag 7 brothers are supposed to report earnings next week, and expectations are high. We should point that out. Bloomberg Intelligence says that Wall Street analysts have trimmed their forecast for several of the sectors in the S&P, but they have not necessarily trimmed their estimates as far and as fast when it comes to the tech sector. They are anticipating not just growth in EPS, not just growth in revenue, not just growth in margins, but growth in EPS and margins that in some cases are going to be double what we're going to see for the broader S&P 500. Alphabet is sort of emblematic of that, and we're going to get back to Alphabet in just a moment as those shares continue to rally here in the after-hours trade. But let's take a look at one of the tech companies that maybe, should have sort of been part of the pack, but for whatever reason, isn't. Intel shares down about 6%. They just reported their earnings for the most recent quarter. I'm not sure the backward numbers matter as much as what the company said about what's going to happen going forward under their new CEO. Ed Ludlow, the co-host of Bloomberg Technology, had a chance to sit down with the CFO. What did he have to say, Ed?
Well, he's doing the talking because his boss hasn't been in the job that long. But basically, they are going to streamline this company. They're going to reduce OPEX. They're going to reduce CAPEX. And that is the focus of Lip-Bu Tan. You will have seen the report this week that Bloomberg had that Intel was going to reduce headcount by 20%. What Dave Zinsner, the CFO, told us is that he doesn't have a number yet. He just knows what the OPEX and CAPEX targets are for this calendar year and for next year. They have been trimmed in the early phase of Lip-Bu Tan's leadership as CEO, and that they are going to focus on cutting out management layers. You know, the focus is streamlining the organization and cutting bureaucracy, which is in line with what we reported, but he doesn't have a definitive number. But you're absolutely right, Romain. You nailed it. Forget the backward-looking numbers. The forward-looking numbers are where it's at.
I'm just curious, just real quickly, Ed, here, though, too. And I know, look, he's a CFO. He's got to focus on cost. But look, I mean, cost cutting for any corporation, particularly of this size, only gets you so far. This is a company that, for all intents and purposes, has been on the sidelines of this big AI boom over the past couple of years. Lip-Bu Tan is supposed to, in theory, right that ship. A, is he going to be on the conference call? And B, what do you want to hear from, or what are you hearing from investors about what they want to hear from him about articulating the longer-term vision?
Lip-Bu will be on the call. And, you know, I think that Zinsner was pretty frank that the trust between Intel and its customer base isn't great at the moment. It hasn't been good. And the domain is very simple. AI accelerators, GPUs that go into data centers to train AI models or run inference. You know, when they did the last layoffs in August, they were heavily over-indexed to CPUs that no one wanted. And what Zinsner said is that Lip-Bu has come in, he has himself had 10 years in the AI industry and has very much focused on saying, we need to start doing the thing that everyone wants, which is in the AI accelerator market. They slightly outperformed in data center and AI in the quarter gone, but they've definitely noted a pull forward effect of tariffs, right? People scrambling to front run tariffs in the first 3 months of this year. They're not quite there yet in telling us how responsive customers are being to any technology changes, but Lip-Bu Tan's not had any time either. Yeah. So to be fair, they were very cautious in the statement, cautious on the phone. It was very much give us some time to implement this disciplined strategy.
All right, Ed Ludlow, the co-host of Bloomberg Technology. Intel shares down about 6% after posting a slight decline in revenue to just under $13 billion, adjusted EPS of 13 cents, missing analyst estimates. And the guidance going forward is more, I guess, commentary at this point. The company did say it sees a revenue range of 11.2 to 12.4 billion. That's an incredibly wide range, but the top end of that range is below the average of analyst estimates. Matt Bryson joins us right now, Managing Director of Equity Research at Wedbush. And Matt, you know, we were talking with Ed, and he was talking a little bit about the CFO's focus on cost cutting. They've been pretty aggressive with the cost cuts. They announced more job cuts as well here. How far is that going to get them, Matt?
I think it certainly gets them to better earnings in the intermediate term. Having said that, at the end of the day, what you really need to do is grow your business, and you can't cut to growth.
So what is that business going to look like? I mean, when we talk about, and I know we have to put the asterisk that, you know, Lip-Bu Tan has been in this job for, you know, all of about, 2 hours, and, we should give him time. But I am curious as to whether you think he's going to come to the table with something new and novel, or something that's going to be more an extension of what Gelsinger tried and failed to do.
I think it's got to be a little bit of both. So new and novel takes time, right? When Pat came in, he was talking about 3-year product cycles. I think that is the case. And so when you talk about them getting into the AI market, that's going to take time. Having said that, they have their new 18A process. Product's supposed to hit at the end of this year. And so I think in the intermediate term, what really is going to determine whether Intel's successful or not is what Panther Lake looks like at the end of this year. Is it finally a better product or a competitive product with AMD, or does AMD just continue to take share?
Is there a sense here, though, that when we talk about Intel's role in all this, and the idea that, you have a White House, basically a Washington environment right now that wants to see more homegrown technology, more homegrown manufacturing, and to a certain extent, Intel, certainly under the Biden administration with the IRA, Intel was kind of seen as being one of the pillars of that. Where does that stand right now? Are they still that, or do they have the potential to be that?
I think they have the potential to be that. I think it really comes down to, again, does this 18A process work, right? Because Intel didn't go bad because of competition. Their struggles all came about because they couldn't get their technology right. And so at the end of the day, they need a competitive fab process, a competitive foundry process to be a good company again. And I think we find out more about that at the end of this year when you finally get that leading edge process node that they've been talking about for 3 years integrated into products.
With regards to sales going forward, and I thought it was interesting in the press release, they kind of gave a nod to tariffs and the economic uncertainty associated with that. And of course, this is a company that probably has more exposure from its end users more than anything else. Is there any sense here that things won't necessarily be as bad as maybe what the drop in the stock has reflected over the past few weeks and months?
Yeah, so I think they have a difficult Q2 and Q3. The tough thing from my perspective is, you talked about pull-ins. Clearly, there were pull-ins in Q1. I think there very well may be pull-ins in Q2. I don't know how much their guidance looks at the potential benefit they get from pull-ins in Q2. Like, have they fully accounted for that? But having said that, behind the scenes, I think in desktop, in notebook, in servers, they're losing share to AMD, and so Q1, Q2, Q3, once you normalize for everything, was always going to be difficult. And so I think that's what's reflected in numbers. Having said that, they're trading close to book. Mm-hmm. So I don't think the stock can go down that much unless people think that there's real financial concerns moving forward. And so I personally think the next catalyst is, again, that 18A process, that Panther Lake part. And if it's good, I think Intel ends up in a better place. If it's bad, that plays into the financial concerns type of narrative.
Are you anticipating any sort of additional M&A, particularly divestitures, that is, out of Intel?
At this point, it's really hard to see what that they divest. I mean, certainly Mobileye, which they're running as an independent business, they could get rid of that property fully. But you move beyond that, they've gotten rid of Altera. They've parsed out, or they've closed a lot of their networking business. I mean, at this point, you really have kind of the core Intel businesses, right? You've got the compute in PCs, you've got compute in servers, and you've got what they're trying to do in AI. And I can't see them divesting their AI efforts, because that would seem to be the antithesis to what Lip-Bu is trying to accomplish.
All right, Matt, got to leave it there. I'll let you get back to work here. I know you're busy. Matt Bryson over at Wedbush, a closer look at Intel. Those shares down about 6.5% in the after hours trade as we await that conference call, which, of course, will feature the CFO and, of course, the new CEO, and get a better idea of what his vision is for the company going forward. Meanwhile, we did get earnings out of Alphabet. Those shares actually moving higher. We know their vision. I guess the big question right now is the execution, and how do you execute in an environment that is looking increasingly uncertain? Revenue holding up, so too is the ad business, but still some concerns right now about AI as well as some of its other bets. Brent Thill joins us right now. He's tech sector leader of software and internet research at Jefferies. Overall, Brent, I mean, this looked like a pretty good report here. Were you impressed by what you read?
Top line was 1% better. The bottom line was really impressive. So if you think about what you can control in a tougher environment, you can control the bottom line. The overall ad business was in line, YouTube in line, cloud in line. So it was nothing, again, no big shocker on the top, and I think the stock's fading a bit because of not a lot of upside on the top. But again, free cash flow really good on the bottom, and as you know, Google doesn't guide. Mm-hmm. They don't really give you anything. They're the only tech company that really doesn't give you any color. So any clues on the call about the outlook, which they rarely ever give you. So I think we're all searching for what's actually going to happen in the overall environment, because again, it's been way too early for any of these tariffs or any of these potential concerns around the slowdown to catch up to tech yet. It'll most likely catch up in Q2 into Q3 as a delayed effect.
Well, so sort of two elements, though, coming into this earnings report, not just for Alphabet, but really for all the big tech companies, is partly, obviously, the ad side of the business, but also this idea of AI build-out and the CapEx spend and things like that. Let's start with the CapEx side of this, or AI, I should say, overall. Are you comfortable right now with what they've articulated on that side, and what do you want to hear from them on the call today?
We're really early in AI, and we just came off a Jefferies private internet and software conference where every major AI vendor was saying they're not seeing a slowdown. And so the question is, if something gets pushed, is it AI or is it non-AI? And what we're hearing is some of the non-AI components are getting pushed. Microsoft said that even in Q4 that AI was good and the other core workloads weren't as good. So we continue to see AI's front and center. Google just committed to $75 billion of CapEx spend just a couple of weeks ago at their conference. We think the rest of the industry is committed. And even if we went into a tough time, we believe that these companies would lean in and they wouldn't back off, because in the past downturn, everyone wanted more upside. Every CEO was like, we wish we would have spent more because we would have come out on the other side of this with more market share. So at this point, I think we're super early, and we expect most of these companies to continue to stick to their CapEx plan. Microsoft's obviously clearly backed off a bit, but not in a major way.
What's the balance, though, as Alphabet sort of pushes deeper into integrating AI more into its products and services, and the idea that its primary business, or at least the one that we're all familiar with, the traditional Google search, there's been concern here about cannibalization of that, if not by Google itself, but certainly by its competitors.
Yeah, I mean, I think we as all consumers are using ChatGPT and Perplexity more. I use Google less, and I still have Google and I still go back to it. But I think there is a risk, and there's emerging new solutions that are really good that we're using to start our searches. I ultimately end back at Google because you can't transact and do the things you'd like on some of these other platforms. Give it time. I think ultimately that will happen. I think anyone that's used Perplexity understands how good the user interface is. When you want something summarized, it's way better than Google. Gemini is catching up, though, and what Google needs to do is figure out how do they fuse Gemini, search, and the rest of the AI portfolio along with all their hardware and make it seamless and easy. And every advertiser is saying this, but they haven't figured that out yet. So they have to put these pieces together. We think they can.
Yeah.
But it's going to take time. And again, the good news is they have competition. The good news is there are others that are coming after them. And again, many consumers are using more of these tools every day, and they're getting better, every day. So Google has to put.
All right, Brent, got to leave it there. Let you get back to work. Brent Thill, tech sector leader of software and internet research over at Jefferies. Alphabet shares slightly higher in the after-hours trade as we await that earnings conference call in just a few minutes. We do now want to turn, though, to the consumer sector. We're getting earnings right now out of Boston Beer, of course, the maker of Sam Adams, a company reporting first quarter results, first quarter revenue that did rise about 6.5%, $454 million in the quarter. That beats estimates. EPS, the bottom line, beat in a big way, $2.16 a share. Street was looking for only 59, and the company says it still sees EPS for the full year in the $8 to $10.50 range. So basically standing by its bottom line EPS forecast. Meanwhile, Skechers, the maker of sneakers, out with their earnings, and those shares are moving lower. The company missing on sales and pulling its annual outlook. Joining us right now is Abigail Gilmartin of Bloomberg Intelligence, who covers the space for us, to talk a little bit about this. So what's kind of ailing this company here? I mean, I understand that all these companies are trying to navigate economic uncertainty. They're trying to navigate tariffs. But this seems more dour than what we've heard from some other companies.
So they pulled their guidance, which I think makes sense given, the uncertainty with tariffs going on. Their sales did meet the low end of their guidance. They missed consensus slightly, but their profits actually beat on EPS and operating margin. So I think that is a good sign that they're able to control their costs while maybe having some lower sales.
What did they say about tariffs?
So with tariffs, they didn't say much yet, and we'll definitely be looking for that on the call as well. But I think given the fact that they pulled their guidance, one thing we'll be also looking for is, early quarter to date trends for 2Q. But Skechers has maybe 40% of their goods coming from China, but over 60% of their sales are from international. So we do think they'll be able to redistribute some of those goods from China to other countries to kind of avoid any large tariffs there.
And we've seen this with some other apparel makers and retailers, the idea that, they have large international exposure in terms of the supply chain, but also they're making things sometimes in the markets that are selling them or vice versa. So they're maybe not as exposed to bringing stuff into the U.S. With regards to just general trends, though, too, because, I mean, if we weren't talking about tariffs and economic weakness, we'd be talking, are Skechers still cool? Are people buying them versus their competitors, like when you look at Deckers and some of the Nike and some of the other brands out there? How are they stacking stacking up in that space now?
They're still stacking up really well. Their comfort and value appeal continues to resonate with the consumer, and I think that they did really well in most of their regions other than China. And what really drove the miss there was China, much weaker, and it looks like it deteriorated from last quarter, which makes sense just given the economic uncertainty there and the consumers pulling back on spending there. So that was really the biggest concern that we were looking for, but everywhere else looked strong.
All right.
Skechers.
All right, Abigail, Skechers shares now only down about 5% here in the after-hours trade. Again, waiting for those conference calls, which of course could change the trajectory of some of those moves in the market. In fact, when we look at the market, at least in the post-market trade here, some of the big gainers on the day are, well, who you would expect. Alphabet shares still holding their gains, up about 4% here in the after-hours trade. Trade Desk and some of the other names in the advertising space also rallying on the back of those positive results out of Alphabet. To the downside, it's Intel, it's T-Mobile, and it's Skechers. We'll be back in a moment. This is The Close on Bloomberg. All right, we're keeping an eye on shares of Alphabet, continuing to move higher here in the after-hours trade. The company beating on several metrics in its most recent earnings report, and a massive driver of that, of course, has been its advertising business. Advertising technologies generating roughly $30 billion on an annual basis here, a juggernaut. But of course, with every juggernaut, some people of course have to look for any flaws out there. So let's find out if there are any flaws going on in that ad tech space. Joining us right now is Mark Zagorski. He's the CEO of DoubleVerify, a company that helps brands improve the effectiveness of their digital advertising. As I like to say, you basically make sure that those advertisers actually get what they pay for, Mark. Google's been pretty reliable for the past few years. I mean, it's been if not the first place to go, certainly amongst, one of the 1, 2, or 3 places to go here. Is that still the case?
Yeah, I mean, look, the Q1 results really are telling, because Google has been a bellwether of digital ad spend. And they had a great Q1 driven by YouTube, which shows not only the resiliency of their ad business, but also of their search business, which is an ad business in itself. So, it bodes well for the digital advertising space, at least for Q1 of this year.
When we talk about their ad business, there is obviously the search side, the traditional search side, when we type into that little box on the screen. There's also YouTube, which is a juggernaut in its own self. And, we always joke that, kind of YouTube is really just, an advertising platform that happens to actually play real content. But it's been wildly successful. And I'm curious if you can draw any contrast or comparisons between trying to sort of manage the ad tech for YouTube relative to managing it on the traditional Google search platform?
Yeah, I mean, look, YouTube has been incredibly strong in the face of what many thought would be lots of competition, right? So in the connected television space, you've had new ad-supported entrants like Netflix and Disney and HBO Max come into the market over the last year, and they really haven't made a dent on YouTube, which is arguably the largest CTV platform out there. So, they started off really as just attracting social dollars and dollars that were going into advertising. They've grown into a connected television, mega player. And, we've seen the power of their ad stack help grow that business, over the last few years. Now, may that change based on recent monopolistic rulings by the DOJ? The jury's still out there. But at the end of the day is these systems and their ad tech systems that have worked together really well have fueled YouTube's growth.
Well, so what's the idea then when we talk about artificial intelligence and a lot of competition in building out chatbots and other things that to a certain extent are kind of just different forms of search, at least for the way a lot of people use it? Do you see that right now as a formidable threat to Google's dominance in this space? Or do you think Google's own AI capabilities will help them keep pace?
Yeah, I was a little surprised that we didn't see any degradation in search in the first part of this year, with so much discussion around the other AI tools like ChatGPT taking up so much mind share. It shows the resiliency of search. And I almost look at it akin to like linear television, right? Everyone thought as soon as CTV came, linear television would just collapse. Well, it's certainly not as big as it used to be, but it's still a $50 billion business. And I think we may see search show the same type of lifespan, which AI is going to start to eat away from it, and it will slowly degrade over time. But Google has the money to play in all ad-supported AI tools in the future. So they may just be moving ad dollars from one pocket to the other, from search into AI-based ad dollars, and it may not impact them at all. So, they certainly are in a great place to take advantage of what's happening in AI and to not be kind of run over by that AI machine.
Another aspect, though, that has come up, and this is something that your company is involved in a lot, in terms of just also making sure that advertiser content doesn't end up next to something inflammatory. Like if you're posting on social media or putting an ad on YouTube, make sure it's not running against something that would be considered offensive to the sensibilities of that advertiser. Is it harder to do that with this sort of AI tools that seem to be, if not autonomous, certainly be running with a lot less human oversight?
Yeah, with every advancement in AI that can create a challenge, I think we can leverage AI to address that challenge. And we do that at DoubleVerify, where a lot of our tools, which are seeking out content that's not aligned with a brand's safety or suitability requirements, are driven by AI. So we like to think of kind of you fight fire with fire. If AI is generating content or results that are kind of misaligned and hard to control, we can use AI to ensure that advertiser spend is kind of okay and aligned with those results as well. So I think with every new technology, there's always challenges, but I think there's always ways to attack those challenges with that technology in itself.
I want to get your thoughts before we go, Mark, just on the broader state of advertising right now, not necessarily specific to Alphabet. I mean, we've been talking a lot on this program for the last few weeks about a potential, let's just say, economic weakness out there. And I know in the old days, when I was starting my career, a lot of people looked at advertising as a bellwether for economic conditions. Is it still that?
Yeah, I mean, I think the one thing that's changed over the last few years is that advertisers, particularly digital advertisers, have become really agile. Right? They can move dollars in and out, not just on a monthly or weekly basis, but on a minute-by-minute basis based on market conditions. And I think, we're going to see that in this market too. What we're hearing from advertisers are, hey, we need to continue to advertise to sell products no matter what the economy looks like. But we're not going to plan so far in the future that we get caught. Right. So I think the tools that are out there and the way the advertisers have learned to react to market conditions have given them a lot more agility in how they spend. And, I think ultimately when we look ahead in the future, just because the economy is soft doesn't mean those advertisers don't need to sell products. And I think they've learned in the past by pulling ad dollars is not a good way to help, bolster your ad sales or your sales. So, the jury's still out on what's going to happen the second half of this year.
All right. Well, we're keeping an eye on it. Mark, I really appreciate your insights. Obviously, you have a really great vantage point there. Mark Zagorski, the CEO of DoubleVerify. As we continue our deep dive into those earnings out of Alphabet as we await that conference call and await more information on AI, more information on CapEx, and more information on the mounting regulatory pressures on this company. The DOJ here in the United States looking to make the tech giant sell its Chrome browser and license search data to its rival. It follows a ruling last year that Google has an illegal monopoly in web search. Joining us to discuss is Mozelle Thompson. He's a former FTC commissioner and now a strategic advisor at UBME. Great to see you, Mozelle.
Hey, how are you?
I'm doing well. I don't know how Google's doing. I mean, they're dealing with several cases right now, and they all seem to link back to, obviously, advertising and, more importantly, their business practices. I want us to talk about specifically the most recent case where we got some insights with regards to the ad tech itself and what the remedy the government would be looking for should, these appeals fail.
They've looked at two types of remedies. There's the behavioral remedies, stop doing what you're doing now or change your contracting or doing things like that. Or the second thing is a structural remedy. How do you wind up dismantling something? For example, divestiture. The government has asked for actually divestiture. That's the most stringent remedy. The challenge for the courts any court is not just figuring out what's happened in the past, but what's going to happen next. This is a market that's changing very quickly, and you've seen that in just your prior guests talking about the advertising market is not just how you do ads online or what search looks like, but what AI is going to do to change all of that. So is Google's position in dominance going to continue, and whether a divestiture, for example, of Chrome is going to actually benefit competition or actually harm competition?
Well, that's what I'm curious about, too. And it's interesting you point out the timetable, too, right? The idea that these cases take a long time. Technology tends to move way faster than what's happening in Washington. So by the time you do get a real verdict and remedies and all that, those companies have moved on to the next thing. We saw that with Microsoft. Was probably one of the best examples of that in recent memory. I do wonder if we're going to see just a repeat of kind of that, where 10 years from now, we'll be talking about Alphabet, and it'll still be one of the largest companies in the world.
Well, that is a danger. One of the problems with any court case is it tends to take things as a snapshot in a market that's moving faster than what that snapshot looks like. So the key is that it's going to be predicting what the future is going to look like, and I'm sure that Google is going to have its own view of what that future market looks like, and DOJ will have its view. It's up to the court to decide which is the most likely scenario.
I am curious about just the FTC and really just the overall regulatory process when it comes to consumer protections, whether it's FTC or DOJ. You spent quite a few years at the FTC, and I know it was a much different time back in the late 90s, early 2000s when you were there. Lots changed. Are the mechanisms, and more importantly, is the cooperation amongst the commissioners consistent with proper enforcement, proper investigation, and proper remedy?
Well, one of the things that's happened recently that's unprecedented, a couple of things. One is that that the President Trump, has issued an executive order saying that independent agencies like the FTC will now be brought more under the executive's control. That's unprecedented. Second is the commission like the FTC usually has no more than 3 of one party. It has 5 seats. And in this case, they fired the Democrats. So now there's only 3. And so they're all Republicans. And so those seats can, in conjunction with the president saying he's going to take control of independent agencies, really changes the tenor. There is really no dissent. So that if there's alternative views of what the case might look like, or what the remedies might look like, or what a settlement might look like, there's only one view, and that's the one that's in the executive.
But do companies want that? And I know you've been an advisor to big tech companies, including Meta. And it's one thing to say, okay, we have a hostile FTC, which a lot of people thought we had under Biden, under Lena Khan. But it's also another thing to say we have an FTC where we have no idea what the decision-making process is going to be when it comes to investigations and enforcement.
Well, one of the things that's really important from the investor standpoint is whether you have certainty or uncertainty. Now you have total uncertainty, right? Because it's hard to predict what a case is going to look like and what the ultimate remedy is going to look like and who actually has a sense of finality. That's going to be an interesting challenge. Stay tuned for the news at 11.
Would you, and this is just hypothetical, and I don't want to put you in trouble here, but would you advise, if a company came to you and said, look, we are planning this big merger, 2 large companies, maybe very closely aligned in terms of customer base stuff, would you advise them to pursue that in this current environment?
What I'd advise them to do is to pursue all options. That means let's file the case, see what it looks like, see what resistance you have. The FTC and DOJ have said, especially in the tech sector, that that we're going to continue our enforcement posture. Now, whether that actually results in settlements the way we have in the past or ultimate litigation, that's yet to be seen. It's still early on in the Trump administration.
This is a loaded question, but do you think over the years the FTC has actually been effective at its intended purpose?
I think there are places where it's been especially effective, and there are places where it hasn't been. I think in the area of privacy and data, it has been incredibly effective. In consumer rights, I think it's been incredibly effective. I think it's still feeling out the way they view technology markets. That's an iterative process. Just because, if not any other reason, that the technology markets are different from other markets. It's not based on one single innovation. It's about building on innovation over time. So the traditional way that tech companies and technology advances is by taking ideas and building upon them.
But it's interesting you say that because, I mean, Lena kind of got criticized a lot. But one thing that she did get lauded for, at least in some circles, was a rethink of exactly what you're saying. The idea that you can't really apply rules from the Industrial Revolution to the technological revolution is just totally different. And she seemed to at least be attempting to try to address that. Now, she might have failed, but she certainly attempted that. Do you think we'll see another attempt at that, a meaningful one?
I'm not sure about that. You know, Lena Khan did do something by essentially saying, let's re-examine this to figure out where we're going. I'm not sure I would have reached some of the same conclusions she has, but I think that it's an important place to start. It's hard to see where this administration is going to go now. They haven't signaled that yet. They've said that they're going to keep in touch and tough enforcement, but they haven't necessarily said where they want that enforcement to lead.
All right, so, and I'm just going to wrap this up too. For investors who look at these big tech companies who are concerned about what the FTC will do, they were concerned the previous 4 years, they're still concerned now under Trump. When you look at Alphabet and Apple and all the big Mag 7 companies, Microsoft, do you think they're still going to be relatively intact in terms of size and scale down the road relative to today?
Well, I think that one thing that they have going for them is they provide value. They provide value to their users, and as long as they consistently do that, then there will always be an audience and investors who want to invest in them. So I think that that's the thing that people have to look at. In the end, market performance does count.
All right, Mozelle, that's a great place to leave it. Really great conversation. I could keep going here. Mozelle Thompson is a former commissioner of the United States Federal Trade Commission and now a strategic advisor over at UBME Inc. All right. We had a wild day on Wall Street, but it was actually to the upside. 3 straight days of gains, and the big question is, does it turn into a 4th straight day of gains? You don't see it on the screen, but that's going to really hinge a lot on Alphabet. Those shares are higher by about 4%, and that's going to be a big boost to the market in the morning. But a potential drag could come from Intel, down about 5%. Skechers, down about 6% as well. And you're also seeing some further weakness here in some of the pharmaceutical names, as well as in some of the names in the telecom space. Does that add up to a plus or minus sign tomorrow? Well, we're going to have to find out. Stick with us. This is The Close on Bloomberg. We continue our focus on big tech and take a closer look at Intel. Those shares down about 5.5% in just about 11 minutes time. That conference call is set to kick off. And of course, the star of the show is going to be the new CEO, Lip-Bu Tan. That earnings call debut will, of course, probably pose quite a few questions about the company's guidance going forward. And more importantly, just what type of leader Tan will be. Bloomberg's Sarah Frier joins us right now from our West Coast Bureau. And all eyes are going to be on this guy. And I know he comes to the table with a lot of a good pedigree, if you will, but also high expectations, Sarah, right?
I think there are high expectations, but there's also only so much he can do. He's just starting this job. There's so much uncertainty, not just within Intel about how they're going to create and boost products that the market needs right now, but also the broader market environment, the uncertainty around tariffs, the uncertainty around supply chain. I mean, that is causing a lot of issues just for their ability to even generate the level of confidence that they want to generate going forward. So I think this earnings cycle, it's important for him certainly to build that rapport with investors, but is what he says going to change their outlook on the future of Intel? I don't know if this quarter is going to do it.
Well, I am curious, though, too, but even like longer term, too, because there was a lot of discussion about picking the right person. And even when they picked Gelsinger, there was a lot of questions. Is this the right approach for the company? And he lasted, 3 years or so. Lip-Bu Tan, of course, has a great pedigree. But the question then becomes, is he the right person? Do you want a manager, kind of a straight corporate manager? Do you want sort of a tech geek, or do you want something in between?
I think at this point you really need a visionary, somebody who can take Intel out of its slump in a way that looks at what the future is going to need. In the chip industry, you have to be thinking 5, 10, 20 years ahead from today. If you're building these factories, trying to design the next step. So right now they're really behind in the AI race. They're losing a lot of share in their key categories. And then they're dealing with this trade war and the China issues. So I think that he needs to come in and explain that he knows what he's dealing with, right? Not sugarcoat it, but also have a vision for how Intel's going to get out of that and build a rapport with investors and make them feel buy-in for that strategy.
Yeah, and of course, again, we always have to put that asterisk that this guy's been on the job for, barely a month here. So we have to give him some time. Meanwhile, the flip side of that, I want to talk a little bit about Alphabet because, of course, they've had a lot of stability over the last few years. Of course, Sundar Pichai's been at that helm, at least at the top helm, for the last, 5 years now. And this company has knocked it out of the park. We just got their earnings again. And despite all the talk about economic weakness, all the talk about ad weakness, all the talk about it being behind on AI, the numbers look pretty good, Sarah.
Well, it's better when you're winning the category, right? They are a tech giant that dominates in search, and when somebody has a question about something, they still go to Google search. And their efforts in AI are really early, but they did invent this category. They did build the tech that underlies the large language models that we all use initially. They just have been slow to deploy it in their own product. And we will see what trade-offs are ahead for them. I think it's really too early to say that they're going to continue to dominate because for the first time, Google does have significant competition on search. People are going to AI chatbots for answers that they might have otherwise gone to Google search for. So it is still a really interesting time for the company in terms of its commentary. What are they going to say about the calls ongoing right now? What are they going to say about the new competition that's emerging, but also the fact that they are under 2 antitrust challenges by the federal government and actually in court for the next few weeks to determine if they're going to have to spin off part of their business.
All right. Sarah Frier out there on the West Coast. We should point out that conference call for Alphabet now underway. The CFO, Anat Ashkenazi, speaking right now on that call. And, of course, still waiting to hear from some of the other folks there going forward. A focus on big tech, a focus on earnings as we push ahead for what you're going to have your eyes on over the next 24 hours. That conversation after the break. This is Bloomberg. All right, let's push ahead to what markets will have their eye on over the next 24 hours, and that includes more earnings. We got a read on consumer staples this morning out of Procter & Gamble, out of Pepsi. We get Colgate-Palmolive in the morning. The street looking for organic sales growth of about 2% on the back of earnings of about 86 cents a share. Remember, this is a stock that, while higher than where it was after its last earnings report, has fallen about 12% here in the month of April. We're also getting Phillips 66. Keep an eye on that space and keep an eye at 10 a.m. Washington time where we get the latest read on the University of Michigan consumer sentiment. This is a final revision here. We are expecting revisions to the downside on all of the key metrics and one key revision to the upside, and that's on inflation expectations. The IMF World Bank meetings, they're still going on in Washington, but they actually wrap up tomorrow. We'll have continued coverage of everything going on down there at those spring meetings right here on Bloomberg.